Casper testing the first IPO for cash-burning companies since WeWork. What's the appetite like, Sonali?
Well, listen, Casper was an unicorn last year, and as it goes into an IPO, it looks like it'll be worth less than it was in its last private financing round. So what does that mean? It creates a sense of worry that when people start to exit, they won't be able to exit at the same returns that they had in the past.
So there's a concern that at a time when you're seeing these private valuations come into question, you're still seeing record amounts of money getting raised on the venture capital side. What is that telling you? Who's raising money and how is the appetite there?
Well, the question is how fast can they put that money to work, right? If you're investing in venture capital and even growth equity, it's not a huge amount of money to put to work at one time. The idea here is, yes, you'll get a lot of zeros, but hopefully you'll get some good exits. But what happens if those markets are not receptive enough to get that exit you need for that return? Will the returns come down in the future?
Is that stifling fundraising on the venture capital side?
Right now, there's no evidence of it, right? We have DoorDash also coming up ahead, big loss-making company. We have Airbnb, which can be profitable. And so there's a couple chances this year for the public markets. Remember, fewer companies are going public in general. So the investors coming into them might still want to bite when there's so few of them left.
All right, we'll see. But it brings us to Adam. CLOs, meanwhile, have been underperforming other types of credit, but are starting to come into favor again. This goes to the whole flood of cash issue. What's the relative valuation case for CLOs being made right now?
All of last year, CLOs were cheap to investment grade corporate. So right now, spreads are just beginning to tighten again, but they were a great value last year. However, there's a lot of risks, as we know, in leverage loans.
Well, okay, so the risks in leverage loans and CLOs, collateralized loan obligations, are packaging these leverage loans, structuring them into a waterfall kind of structure. Are there inherent risks that are getting kind of embedded into the structures of some of these funds that sort of are different from the plain vanilla securities?
Absolutely. As leverage loans are being downgraded to CCC, this is causing a problem. So CLO managers are looking for more freedom and flexibility to get kind of distressed loans in there. That's not great for all investors in the CLOs, and they're kind of fighting back at these loopholes and documentation changes.
Is anyone saying that this market's getting frothy, or perhaps the valuations are a little high given some of the embedded risks, or are people still saying that the relative valuation is there?
Relative value still looks good, but debt investors need to be wise about this. They need to find the right CLO manager, as corporate credit might take a whole repricing a year from now, and that could be very dangerous for certain investors in CLOs.
All right, and that certainly, I'm sure, is music to a lot of CLO managers' ears who are saying, we're the good guys. Stay away from all the bad guys out there. It does matter how good your manager is. Meanwhile, Kelsey, private credit is getting so hot. Some funds are looking for ways to get mom and pop investors into the game. Kelsey, what's the latest on that?
So we recently saw a bit of news come out of 9point, which is a fund based in Toronto. They're really seeing an opportunity in targeting retail investors. So mom and pop that want to take advantage of the yield that you're able to get into private credit, but are still scared of the illiquidity that there is in the asset class. So 9point has created a fund that invests in private credit, but also offers a bit more liquidity through this product.
So, yeah, this does raise a question because private credit is thought of as a highly illiquid form of asset, and yet typically mom and pop investors are looking for daily or weekly liquidity. So what are some of the measures that people are taking or ways that people are mitigating that risk?
Sure. So 9point, for example, it's putting about 20% of the fund into liquid securities or cash to give a little bit of that liquidity. But they're also putting in some measures to only allow investors to pull out with 30 days notice. And if redemptions hit a certain threshold, they're able to space them out over 18 months. So it does create a little bit more liquidity than you would typically see in a private credit fund, but it's still a long ways away from, the typical investment that a retail investor would typically make.
Kelsey, just real quick here, do you get the sense that this is getting adopted more broadly, the idea of trying to cater to mom and pop investors for private credit?
Well, retail investors right now really make up a very small part of private credit funds, but as the industry grows, right now the asset class is $800 billion. We're going to see more and more folks try to expand their breadth of investors, and we could see more coming this way.